Okay, quick update on just a few of our various portfolios. Now, the portfolios are created as models from the filtered list. Okay, this is going through 10,000 equities, US, European, UK, and then building them based upon what clients want in terms of returns versus drawdowns, risk, volatilities, and so on. And sometimes clients will say, well, I don't particularly like this company, so I don't want that in a model. So all the models are bespoke. But anyway, to give you an example of just some of them in comparisons, this is where we've got to. I'll move myself there for a second. I'll show you more. So the 45 plus so far this year is up 13%. Now, all of this assumes you're just sleeping at the wheel. All of this assumes that even in a year like 2022, you don't exit. So forget daddy bears and all of that. You're just sleeping at the wheel. You could call that the worst case example or the best case, depending on your views on markets. So these are not traded, as in you're not going in and out, and thinking you've got a crystal ball. For comparison purposes, I've put the S&P 500 here and the UK All Share. Now, I want to talk about the S&P and the FTSE All Share for a second for this reason. Unusually, the All Share has done better than the US there. Generally, it tends to be half as good, albeit there are some exceptions like 2022. It's because of 2022 that your wealth advisor will use that as an excuse. Well, you don't want the volatility. It's better not to be in American equities. But however, you can see year after year, the Americans tend to do significantly better with relatively few exceptions, at least twice as good. Okay. So I wanted to draw that attention. Let's now look at some of the US exchange traded funds. These are for American clients. UK ETFs are here. Remember, if you're in the UK, you usually can't buy US ETFs. And similarly, if you're in the US, UK ones, you wouldn't be interested in anyway. That's a generalization. That doesn't mean you can't. When I say US ETFs, I mean those outside of European regulation, UCITS regulation, and so on. You can buy a US basket of stocks as long as they're listed in under European regulations. So you can have US coverage through exchange traded funds in the UK. It's just that you can't have exchange traded funds that are listed in the US. I know it sounds complicated. Now, US exchange traded funds for US clients, that's how that's done, which is all well and good. Oh, and by the way, in case you're wondering, well, wait a minute, why have you not got 2016 here and so on? Because some of the companies in the Quality 5 Plus didn't exist back then. And we think that's pretty good coverage. I also want to draw to your attention the volatility of returns. Look at that. You can go from 1 or 7 to this. The other point is intra-year, of course, you could get significant dips. That's just what's happened by the end of the year. So don't get carried away. And the past is no guarantee of the future in any event. Okay. Let's look at the UK ETFs. Now, why doesn't that go lower? Well, because some of those exchange traded funds didn't exist. And that's a big limitation on looking at the data historically in any event. Okay. All of these are selected in the case of stocks like these, based on value, growth, incomes. We want undervalued companies that are growing. We're not looking for overvalued companies which aren't growing, to put in simple terms. Similarly with exchange traded funds, we're really looking for high sortinos. We're not looking for narratives and stories. So just because Kathy Wood has advertised it as AI, that's her marketing spin. We don't care. We're looking to see what the data is. So a very new ETF wouldn't be covered by us because we just wouldn't have no data, in the same way Warren Buffett doesn't do IPOs, new issues. Okay, this is the model UK ETF optimized. Optimized just means efficient frontier. So you're looking at historic drawdowns and see if for the same drawdown you can get a better return by changing the allocations of what you hold. The AI picks, that means, well, we've uploaded all our database of 16,000 securities and then filtered those and asked AI to do the weighting instead of us doing it, and saying which of these criteria are important. And then to avoid curve fitting or fitting to history, let me say that again, to avoid curve fitting and fitting to history, there's a clue that we didn't curve fit or fit to history, because otherwise that would have been positive. The best way to curve fit and fit to history is you just take a bunch of stocks and say, well, which ones would have given me the best return since 2017? Well, that's just historical cherry picking. So to avoid that, what we did is look at the criteria first and weightings based upon the academic literature, not based upon the stocks, and then ask which stocks meet these criteria. okay, as opposed to, hey, which stocks have done the best over the last 18 years or 7 years or whatever? Well, that's curve fitting. Got it? And the qualitative factors we looked at, or quantitative and qualitative factors, were undervaluation, high growth, dividend yields, and so on. S&P 500 filtered highest Sortino. So we looked at the S&P 500, which ones had low valuations, high growth, and had also the high Sortinos. Not just high Sortino, okay? And that's what's happened there. Again, there's a slight limitation to what you can do because obviously things go in and out of the S&P. So you might say, well, wait a minute, why don't you just redo that every time? Well, you could if you've nothing better to do. Quality 5, that's just what we call our quality 5 stocks. And they're, again, asleep at the wheel. Don't do anything. No daddy bear rules, nothing at all. That's what happens. And that's, what would kill people. So I just wanted to share a bit of what we do with clients and for them. It's for education and information purposes for the clients when we create these models so that they get access to all the data, all the education, and so that they can have peace of mind of transparency. We don't manage their money. We don't take their money. We don't control their portfolios. They have control over that with whichever broker they choose. If they happen to be with Barclays or Interactive Brokers or AJ Bell or Hargreaves Lansdown or Interactive Brokers, entirely up to them. And what they decide to go with, entirely up to them. All we can do is give them the data, the information, the know-how. Then, bit like buying a car. Whether you choose that model or that, or don't buy anything at all, entirely up to you. You're in charge, but at least you've always got the data and the person working for you to give you all of that. Okay, so I just wanted to share some of that with you. Thank you very much.